For generations of Canadians, buying a home was the only sure thing. You bought the house, you paid the bank, and 30 years later you were sitting on a small fortune. It was the closest thing this country ever had to a guaranteed win. But in 2026, the math has fundamentally changed. Two things broke the old formula at the same time. Prices climbed to levels your parents simply wouldn't believe. And the cheap money that made those prices bearable, it vanished. So let's say it's you. You've done the hard part. You've saved a $100,000 deposit, real money, years of discipline, and now you're standing at the fork in the road. Is the bricks and mortar dream still a wealth builder? Or in today's market, is it a weight around your neck? A 30-year anchor dressed up as an investment? Let's run the numbers. No hype, just the math. Here's the first myth we need to kill. Everyone says renting is throwing money away. And sure, your rent disappears every month, and you never see it again. But ownership has its own pile of money that vanishes into thin air. Economists call these the unrecoverable costs, and most first-time buyers never see them coming. Start with property taxes and insurance. This is the hidden rent you pay to the city, whether your mortgage is paid off or not. You never actually own your home free and clear, miss enough property tax, and you'll find out very quickly who the real landlord is. On a typical GTA home, that's several thousand Canadian dollars a year, gone, every single year, forever. Then there's maintenance. When you rent and the roof starts leaking, you send a text. When you own and the roof needs replacing, you write a check, $15,000 or $20,000, and you smile while you do it. Flooded basement after a storm? That's you. Cracked foundation? That's you too. When you own, you are the insurance policy for your own shelter. There is no landlord to call. You are the landlord, and the bill always lands on your desk. And if you're buying a condo in Vancouver or Toronto, meet the monthly siphon, strata fees. $550 a month is common, and that number only ever moves one direction, up. That's before your mortgage, before your taxes, just for the privilege of holding the keys. Add it all together, and before you've paid a single dollar toward actually owning the place, thousands are already leaving your account every month, never to come back. That's the ownership rent nobody puts on the billboard. Now, the big one. The reason 2026 feels so different from the boom years. Rewind to 2021. You could lock a 5-year fixed mortgage at around 1.5%. Money was practically free. At that price, borrowing $500,000 barely cost you a coffee a day in interest. Fast forward to today. That same 5-year fixed now sits at around 5%, and that one change rewrites the entire story. Watch what it does to a $700,000 mortgage. Your monthly payment lands at roughly $4,100. But here's the part nobody tells you. In those early years, almost $3,000 of that payment, every single month, is nothing but interest. It builds you no equity. It buys you nothing. It's just the rent you pay the bank for the privilege of borrowing. Stretch it over the first 5 years, and the picture gets brutal. You'll hand the bank about $165,000 in pure interest, while only about $80,000 actually chips away at what you owe. So much for renting is throwing money away. You just threw away the price of a small house. Straight to the bank. It's the same home, the same street, the same paint on the walls as the 2021 buyer. The only thing that changed is the number on the mortgage, and that number now decides whether this house lifts you up or slowly bleeds you dry. So here's the question almost nobody asks. What if you didn't buy? What if you rented something modest and took the difference, the deposit, and the monthly gap and invested it? Say you take that $100,000 deposit, and instead of handing it to a seller, you drop it into a low-cost global ETF inside your TFSA. Every dollar of growth completely tax-free, no CREA, no capital gains, forever. If it compounds at the long-run market average, in 25 years, that single deposit could grow into more than $500,000. Now add the monthly gap, the difference between that big mortgage and your modest rent, and funnel it into your FHSA and your TFSA too. Invest around $1,000 a month. And over the same 25 years, history suggests that a loan could swell to roughly $800,000. Put it together, and the renter who actually invests the difference could be sitting on well over $1 million in cash, liquid, spendable. That's paper wealth. And it stacks up shockingly well against the brick wealth locked inside a suburban home you can't touch without selling the roof over your head. This is the part that stings. You've been taught the renter is the fool and the owner is the winner. But the renter, who quietly maxes a TFSA an FHSA, and even an RRSP, year after year, isn't falling behind. In a 5% world, they might be quietly winning. But, and this is the honest part, there's one thing the house does that no spreadsheet can. It forces you to save. Because let's be real, most Canadians will not invest the difference. They say they will. They won't. The plan to drop $1,000 a month into an ETF quietly turns into a nicer car and a trip somewhere warm. A mortgage doesn't care about your willpower. It shows up every month, non-negotiable, and slowly turns your income into equity, whether you feel like it or not. The house is a locked piggy bank, ugly, illiquid, but it works. And for a lot of people, forced savings beats perfect intentions every single time. And there's one more thing the house has that the stock market doesn't: leverage. Think about it. Real estate is the only asset on earth where a completely normal Canadian can walk into a bank and borrow $500,000 to make a single bet. No hedge fund, no connections, just a job and a deposit. And if your home rises even a little, you keep all of that gain on money that was mostly the bank's. That leverage has been the secret sauce of Canadian wealth for decades. But leverage cuts both ways. In a world of 1.5% money, that borrowed $500,000 was almost free. In a world of 5% money, that same leverage is expensive. And if prices stall or slip, you are paying a fortune to hold an asset that isn't moving. Leverage is a superpower when rates are low. When rates are high, it can quietly become the weight around your neck. Which brings us to a strange feeling a lot of homeowners describe. You pull up your net worth at the start of the month, and on paper, it looks fantastic. But then it hits you. 70% of everything you've built is locked in the walls. You can't spend it. You can't touch it. To get at it, you'd have to sell your home or borrow against it with a HELOC, going right back into debt just to reach money that was supposedly yours. Rich on paper, tight on cash. That's the quiet trap of the brick fortune. So how do you actually decide? Here's a clean framework. Call it the 5% rule. Take the price of the home you're eyeing, multiply it by 5%. That single number roughly captures your yearly unrecoverable cost of owning, property tax, maintenance, and the opportunity cost of your down payment, all rolled into one. Then divide by 12 for the monthly figure. On a $1 million Toronto home, 5% is $50,000 a year, about $4,166 a month that you never get back. Now here's the test. If you can rent the same kind of place for less than that, renting is the smarter financial move, and you invest the difference. If comparable rent is higher, buying wins. In much of the GTA and Vancouver, equivalent rent runs closer to $3,000, which is exactly why, on paper, renting and investing quietly beats buying in the priciest markets. Run the same math on Calgary prices, and the answer can flip completely. The point is simple. Run your own numbers for your own city before the bank runs them for you. So, is buying a house in Canada still worth it? Here's the honest answer. A house is a home first and an asset second. If it gives you stability, a place for your family, and it forces you to save, that has real value no spreadsheet can measure. But in 2026, the smart move isn't buying as much house as the bank will let you. The smart move is buying with your eyes wide open, knowing the true cost, knowing the trade-offs, and making absolutely sure of one thing, that you own the house, and that the house never ends up owning your future. If you learned something from this video, don't forget to like and hit subscribe. I'll see you in the next one.